All right, team. So we are starting on the unicorn webinar right now. This is just basically Congo will be the one running this, and he's going to be going over the model that one of his model that he uses to trade, and he's pretty successful with it. And you guys have been kind of requesting and asking him about it. So this is based on per your request. He will be giving it a rundown here on what he does and what he looks for in this model for execution. Okay, so go ahead and the stage is yours, Congo. I'm going to mute myself.
Hi guys, so the unicorn model is the model that I use to actually give me my first payout. It's a very strong model that even ICT himself said is the one of the best model to go off. But the only issue is that it does take a lot of patience and hard to find. And what does it usually and what does the unicorn model consist of? It usually is a breaker block plus the FVG. That's literally it. Just a breaker block and FVG. And how does it looks like? It kind of looks like this. Let's say that you have a bullish model. So it goes down, and up, and you just like that. Okay, so what does it look like? Let me try to get rid of this. Damn it. Okay, well, let's forget about that. But usually what this is a bullish function, and this would be your breaker block right here in this leg. And within that leg, you want to have a fair value gap. So this would be like a fair value gap, and here would be more like a breaker block. And usually you want to enter roughly around here, like at the retest. Stop loss either here or at the bottom, but usually I put it around here. And target is 2R. Very simple. Something like this. So if you are looking, and usually you want this to tap into like a point of interest, which could be the point of interest is going to be right here. And most people are wondering what is a point of interest. So point of interest could be either a fair value gap, higher time frame fair value gap, or swing. Usually that's what I look for. Or it could be like session high, session low. Okay, so that's what would a bullish unicorn would look like. And we could go over a bearish unicorn. It'll be more so goes up, down, sweep out something, and then goes all the way down. Retest down further. This would be more of a bearish unicorn, and this is where you start looking with a fair value gap anywhere in the breaker. All right, any questions so far? All right, perfect. So let's go over some examples for today. Uh, one of the reasons why it is pretty strong because there's a lot of confluence. Well, for one, what it does is that it sweeps out something, sweeps out a low, um, sweeps out a low, or hit into a POI. All right, and then two, it inverses a fair value gap. So it does that. And three, what it does it also does a break structure, and then it forms a continuation fair value gap to go forward. Sometimes you can also use it SMT. So at most, you need only three of them to make it a very good entry. Sometimes four, and or you got all five. That's like A plus list. So let's go over. Let's see today's price action. Just so you guys can see there is quite a bit of being more so on ES. This is the trade I took earlier today. I think it was on like 3 minutes. Yeah. So right here, you can see that we opened, we went down. And the reason why I didn't even short this, because if we look over in NQ, we touched a London low. When I was like, okay, I don't short below London low, and it touched that, so I was like, okay, I'm just wait. And I'm looking for more of a bullish entry. But then ES gave me a clearer picture, and it was stronger. So here, this is the entry for a bullish unicorn. Why? Because this this is supposed to be a order block to go down. But what happens? It broke through the order block and it became a breaker block. So this became a breaker block instead for the bullish entry. And then there's a fair value gap right here. And this would be your entry right here. This candle down, it came back, retest. Sorry, wrong one. Your entry would be right here, came down, retest. For me, my target was just the London highs because there's equal highs right here. But then if you just did 2R, you will have 100 pick on NQ, ES. That's one example. So let's see, let's look at an example of a swing. So that was a swing example. Here's also a good example over here. So this was a good swing, or even here. This is a good swing. We go back to this day, go down to the 5 minutes and take a look. So this what pretty much this is what it is right here. The 5 minutes you don't really see anything. This is I think Friday's play where I was like I don't like to long above previous day high, nor do I like to short below previous day low because those are point of interest. And here we see that this it went over to previous day high, and then it just start going down. At the 5 minute, you don't see anything. What you do is you go down on the time frame. You don't see anything too clear. You go down another time frame. Oh, perfect. This is a clear unicorn that's bearish right here. What this looks like is right here. So you see this move up, down. Nope, it doesn't go that. Let's see. Up, down, up, down. See that? It's not that clear, but what is this? It swept this high right here. This was a sweep right there. It went down, close below there, and you wait for it to you wait for the close below here at the wick because this will give you that change that break of structure, and then you will enter here. Here you could literally enter the moment this closes. Why? Because there you already have a fair value gap form here. You don't have to wait for this one too close to wait for this one. You can literally enter right here because you already have one inside the breaker. But other times you just have to wait for one. But this one you don't have to because it already formed. So this one, the nuances that you can use and enter the moment it closes. And that'll be like where your stop will be slightly over. And then 2R. The reason why I picked 2R is because you don't need a target. You just get your 2R and you call it a day. It makes it easier and you don't have to keep pushing, and then next thing you know, it just reverses on you. That's why for me, 2R as target is like the best. Any questions so far? Okay. This one you don't have to wait because this one already had one form. So let's say we go back to here. Let's go back to here actually. So I'm here. The moment it touches previous day high, I'm no longer interested in long. So the only thing I'm interested in is short. So I'll keep watching. Mark this here because right here, once we close below here, there's a change state of delivery. So this makes me more bearish. So there, moment we close, and guess what happened? There's already a fair value gap here. So I'm like, okay, we already have a fair value gap. We don't need to wait for this one to form the fair value gap. So the moment this closes here, you just enter. No, usually you don't want to wait for if this one's already formed, you don't want to wait for a retest because it could just take off without you. Um, usually some unicorns that will happen, it'll just take off without you and won't give you a retest. But the moment you can confirm that there is a fair value gap that's already inside the breaker, you can enter with your stop here. And sometimes you might just get, it might just do this, and then it goes. Like it does take some time. You might sit and draw down for a little bit, but just have to set and forget. We'll see if I can find some other good ones. Go to the 1 hour. Oh, that's true. So the point of interest that I like to use, it could be change different for everybody. I like to use the 1 hour swings or the 1 hour fair value gap. Um, those are tend to be pretty reactive, and those are the ones that I tend to use. Let's see. Over at this swing. See the next day what happens when we take that. Might be a weak one. And so this one, it doesn't show us anything good unless we get up to here, but up to here is the way it's a big move up already. This one's also a good one right here on 2 minute. It took London high, it kept going up. And usually I just don't long about this. But in the moment we open, but we shot straight down, you can use this as a unicorn down. Here, there's a fair value gap here. So the moment we close down here, you already have a fair value gap here. So you don't have to wait. But if you did wait, this one would be right. There's the other fair value gap right there. So you have essentially two fair value gaps. And this one you can take all the way down. Because this one is above previous day high. And I don't like to long above that. So I would only be bearish once you're above either previous day high, I'll be bearish, or above session high, I'll be bearish. That's all you need. One trade a day. The unicorn. Just you need to have patience. So that's why what I do is I also this is my trading screen. This is literally what I use right here. There's 4 different assets that I use, and these are the ones that I just watch for any reaction, any unicorns, and I just trade off of them. Make sense? Mm. Okay, so when it comes to session highs, those are the point of interest for potential reversal. So session highs, or like London high, Asia low, Asia high, those all those points are points for liquidity and potential reversals. So those are where I start hunting for unicorns, as well as swing highs, swing lows. Those are all good places for potential reversal. So when we mark out any swing high, swing lows like this one, we have a swing high right here. Right. This is where I will start looking. The moment we interact with a swing high, I will start looking for signs of a reversal, which usually consists of an inversion, because that tells you like, okay, we're going to inverse something. That means that we want to go down. Like right here, we have an inversion. Right. This became an inversion. So that shows that the price action wants to go down. And then from there, you're like, okay, now I'm gonna start looking for a closure between this, and then look for a order block that fell, which is this. And you can look for potential unicorns. So session highs, session lows, previous day high, previous day low. Those are all points that you can look for or start hunting for unicorns. Some people use the 15 minutes. So you can use 15-minute swings. Those are potentials, but when it comes to lower time frame swings, they don't work out all too often. They do work. It's just that you also have to base your trade on higher time frame. And if you can do this and just wait for this, you will be very profitable. That's all you need. And sometimes you just, if you do NQ and ES only, what happens is that there will be days when you have no trades because you only have two assets. So oftentimes what people do is they look at other, this is just a mess, but they look at, let me see, sorry, one, here you go. This is something that I also look at. I look at gold and and oil as well. And those are something that I've been tracking recently, trying to get more assets into play. So indices and then golds and oil. But right now, your only focus should be on only EF and NQ, only because you want to get used to it, be able to see it, and then can work off of it. Anything else? You have any questions? I know you've been trying to learn more about the unicorn. Yeah, patience is indeed what people need. And here's something that I like to help visualize something a lot easier. The only problem with this is that it doesn't count on the wick. But let's say this kind of goes up, down, up. So I would just mark out this as a unicorn, and then I'll just go back into the candlestick. And then I was like, okay, so that's what it marks. I'll just highlight that. That can kind of help visualize it. So this side, you can literally do this, and then you can kind of compare it. Okay, so this is potential unicorn. There's a fair value gap right here, and you just wait. This is how I would look at it. Right here too. You look down here, you're like, okay, I see this kind of like a unicorn, and you pull over, and then you come over here to your candlestick, and you compare, and you take a look. There's also one that's potential. Like you don't know if it is or not. You just have to go over to your candlesticks to confirm. But on the line chart, it kind of helps you visualize it, and you just go and confirm. We had a unicorn short forming on ES. Let me take a look. One minute. Oh shit! I don't want to go as slow as 1 minute. So here we have the equal height taken right there. This is just for the unicorn, the one that's more efficient or better one, or the one that doesn't take this long. You see how long it takes just to cross this? I like it when it just goes up and it doesn't take that much long to form a reversal. This one takes a while. So I'm not too keen on it. But if you go in a 2 minute, this one's okay. I probably will take this one, but the only time it'll actually form a unicorn is from right here. Is when it actually forms the fair value gap right here. What is the best time frame for unicorns? Unicorn can happen in all time frames. I don't go anything below the usually 3 minutes, because the 1 minute, look how choppy it is when it comes to waiting. So the price action can kind of wick you out, kind of like scare you. But when it comes to the unicorn, I like 3, 5. The thing about unicorn is that there's also something called a continuation unicorn. It might be another 1 minute. Let's see. Okay, so let's do this. So this is a unicorn right here, overnight unicorn. So we got we got a sweep here, but we compare Lund to NQ, also has a sweep. and it took out all these lows right here. So these is something that you want to consider. It took out all that low. We got a unicorn form right here. It's better in 3 minutes actually. Yeah, 3 minutes looks better. So 3 minutes, we have a unicorn form right here. We have fair value gap unicorn. It reacted here. See how it just opened, went down, reacted to this unicorn, and what happens? It formed a continuation unicorn right there. So you could, let's say you missed the initial unicorn, you can look for a continuation unicorn as well. And this is something that you can do. And that's pretty much the basis of unicorn. It's very simple. Only thing is just the patience that a lot of people don't have and struggle with. Yeah, yes. So if you miss the first unicorn, the second unicorn that happens within that leg up would be considered the continuation unicorn. So it's like the MMX model where you have the first stage, second stage. So the first unicorn is the first stage. The second unicorn will be considered the second stage of distribution. All this is just a retracement down for and then move up. And that's where you want to find the second unicorn. And the second unicorn usually it reacts off of a fair value gap or after it took a swing low something. So that's kind of like a retracement into a point of interest, and then it goes and continue further. Well, as long as you have objective open. So today's objective was London high, because what happened here, we already took London low on NQ, so that formed a SMT, which leaves London high, the only target that we have, or at least for me, only target that I have this morning to continue higher. So you want to take the second unicorn up. Does that make sense? Also on the 3 minute, this is a little bit cleaner when it comes to the unicorn. You see how the 3 minute just literally one fat bar, and that's pretty strong. And you just wait for if there is any fairy gap to form within this bar. We may have actually had one that's that we replayed up to here. There's probably was one that formed. Yeah, there's a few. So yeah, this is something that you would take, and what you would do is just limit. The moment it closes under, you just limit. You don't buy, you don't market buy, you limit buy. So that way, once it's retaps, you're in. So the thing about unicorns is limit order. Um, you don't need to market buy, market sell. Okay, and that's it for the unicorn. Very short, very simple, and it's the patience. Unicorn will teach you patience. If you can execute only the unicorn, you can get a payout easily. So you limit is here you do. I need to log in. So here, let's do this. For this one, you just right click and you'll do sell limit. So I'm bearish. I want to sell limit, and it's just limit buy. The moment it touches that, I'm in, and it just short. What unicorn? The one over at ES. This one. Let me see. I have to find out where it's at. Yeah, it pretty much right here. Yeah, it reacted in the 1 hour fair value gap. It never closed over. So if it never closed over, that means it never it's still respecting the fair value gap. If it closes over, this will become an inverse that you can use to find a bullish entry. But since we never close over this bearish 1 hour fair value gap, we're still gonna be bearish. So that's what happens when you're in those fair value gaps. So 1 hour bearish fair value gap, you should only be bearish. If it's bullish, you be bullish. That's it. You should not be bearish in a bullish hourly fair value gap. Does that make sense? So let's say we tap into this, and then we go down and start looking for unicorns because we're like, okay, this, let me actually color it so it'll be easier. Right, so here we are. This is going to be our point of interest. Oh, the one I use is this one, nephew Sam. But the one I use is, so this is the hourly bearish fair value gap, and that's our point of interest. So we want to start looking for a bearish entry, and we're like, okay, it's going. So I would never be bullish until we close on the hourly. So unless we don't close on the hourly, I would not be bullish until then. So then we reacted and we form pretty much a bearish unicorn. And then you can enter 2R. 2R would be right here. So another way that you could kind of want to catch the rest of it is that once you hit 2R, what you do is you move your stop loss down through here. So if it does ever go back up, you already have the 2R. Otherwise, you can target further. Those who wants to trail and kind of catch the whole move, that's how I would do it. And look at that. Look at that reversal. The moment we tap into the hourly fair value gap, that would be your point of interest right there. For me, I use the hourly the most. Yeah, another point of interest that a lot of people like to use could also be OTE. So you can use OTE as your point of interest. It doesn't have to be the hourly fair value gap, swings, or anything like that. If OTE is where you expect the move to react, that's going to be your point of interest. And that's where you start hunting. So the point of interest is where you start hunting. Okay, I think that's it for the webinar. Short, simple. If you have any questions, you can always ping me, and then we can go over more of the unicorns. So the name for this indicator that I use for the parity gap is called FVG/I FVG by nephew Sam. He also lets you do the inverse. If you're interested in that, you can also do that, and then turn on the inversion. Yeah, definitely. All right. If that's, we'll end this seminar or webinar, and then ping me on the channel. Thanks, guys.